The US government is now spending more on debt interest expense. It's spending on, for the first time in its history, than on military expenditure. And the US spends more on its military than the next 9 biggest countries in the world put together. So that's a sign of just how badly wrong this problem's got. The US, which outspends everybody else, is now spending more on its bond interest than it is on defense.
Hello and welcome to the Tin Hat Money podcast. I'm Jasmine Birtles, and today I have with me my friend Tim Price, who runs Price Value Partners, which is a wealth management company in London. And Tim has all kinds of knowledge. He writes for Fortune and Freedom. He writes for various others. He's very active on social media. Go look for Tim Price. And welcome, Tim Price.
Jasmine, thank you very much for having me.
So, Tim, you are my #1 first interviewee. This is the first episode of the Tin Hat Money podcast. And I asked you to come because something that you and I have talked about a lot, I would say, is the potential crash of the bond market. So I thought if we could just unpick this potential problem and why you think it is a problem, why you think it potentially will happen. Can you explain first, what is the bond market as opposed to the stock market?
Sure. Well, as you kind of alluded, the stock market tends to get all the publicity, it gets all the news flow, but the bond market's actually far bigger. So the single biggest component of the bond market is the government bond market, and that's bonds issued by sovereign governments around the world. So if we take the UK by way of example, every time the UK government has insufficient money to keep up its promised, its pledges in relation to the economy and spending, if it can't get that money by tax revenue, it has to borrow it. It borrows it in the bond market. So the bond market is a facility whereby governments and also companies, but specifically in this case, governments can borrow money from institutional investors and make up any shortfall in their spending plans. If we go back a bit, I'd say that the rot set in for bonds and again for government bonds back in the early 70s. So in 71, the US government, the US economy was in trouble. And at the time, the US dollar was pegged to gold and all global currencies were pegged in turn to the dollar. So you had something akin to a gold standard, a gold-backed standard. But the US economy was in trouble because firstly, their welfare state was hemorrhaging money. In other words, they were spending money they didn't have. And secondly, the cost of the Vietnam War was also mounting. So in 71, President Nixon took the dollar off gold. So effectively, he removed the link between the US dollar and gold, and in turn removed the link between all other currencies in the world, all other so-called fiat currencies that was issued by governments, and gold. So from that moment on, for the last 50 years, we basically had very, very few limits to government borrowing and spending internationally. And that's where the problem set in. So the 70s, it wasn't just the de-dollarization or the de-goldization that took place. It was also, we had some Arab oil shocks. We had problems with OPEC. It was a high inflationary decade, lots of social problems, wars in the Middle East, all that kind of stuff, the kind of stuff we're seeing now. And the 70s was a very high inflationary decade. And we'd make the argument today that the 70s is a reasonable comparison to what we're living through now in the 2020s. In other words, high inflationary decade, higher interest rates rising, government debt as high as the eye can see. And in the 1970s, the price of gold, for example, went up something like 20 times.
Wow.
So in the more recent bull run, that began around 2000, the start of the millennium, that decade-long bull run from 2000 to about 2011 or so, gold went up 7 times. But in the 70s, it was 3 times that. So that's one reason why one of the things we think all investors should own right now is gold. Because it's a very good hedge against inflation and financial crisis.
Yeah, this is a really interesting point that we'll come back to. But can you explain again about the connection between bonds, and particularly government bonds, as you say, and printing money?
Sure. So, like I say, the bond market is where government borrows to make up any shortfall in its spending plans. So if we take, say, the UK, and let's imagine that the UK has a 5-year bond out there. So in other words, it's borrowing for 5 years. And let's say, for the sake of argument, the interest rate's 5%. So that's what it's paying for the cost of its money that it's borrowing. So what it practically means is, if you're an institutional investor, because the bond market's a very institutional market, tends to be dominated by pension funds and large investment groups. Those groups will buy that bond today. They'll give the government, let's say, 100 quid to make the numbers simple. And then in a year's time, the government will pay those institutions 5%, or £5. They'll make 5 payments of £5 over each subsequent year. And in the last year, when the bond matures, they'll pay the £100 back. And that's what's known as a conventional bond, a fixed coupon bond, which is why the bond market's called the fixed income market in institutional circles. So these bonds trade every day, or they can trade every day. So interest rates move up, interest rates move down. So let's say you're getting 5% today on your government bond, and you're happy. Imagine now that interest rates, say, in the bank go to 10%. You're only earning 5 from the bond. What that means is the price of the bond will fall to make that adjustment in the so-called yield of the bond. So bond prices change every day. It's an active market. As I say, it's much bigger by value than the stock market globally. Mm. So what you have here is basically a process whereby governments can borrow money, but there is a price to be paid. And that price is paid basically at the starting level whereby the government borrows that money to begin with. And so this is the mechanism whereby governments fund themselves. And the bond market, therefore, is a reflection of what affects bond prices. Well, what affects bond prices are things like the existing inflation rate, more realistically, concerns about future inflation and the future direction of interest rates, all of which, or some of which, are in control of the central bank. So what we saw in 2008, to make it more recent example, 2008, we had the financial crisis, global financial crisis, and we had the failure of Lehman Brothers. Mm. Now, the US central bank is known as the Federal Reserve, the US Federal Reserve. It's actually a private banking cartel, but let's not get sidetracked by that issue. Lehman Brothers was going to fail, and they had a choice. The Fed, as it's called, had a choice. They could either let Lehman fail, and then there would be a disorderly reset of the system, but a free market would ultimately clear up the damage and start again. That's the way free markets work. Free market capitalism works. But that's not what they did. They let Lehman fail, and then they bailed out all of the other participants in Wall Street. So effectively, they printed bucket loads of money to paper over the cracks. Mm-hmm. And that basically is the sort of global financial crisis of 2007, 2008 in a nutshell. Yeah. The problem that caused was that it basically made a corporate level problem, the banking sector problem. It made it into a global problem because it added to the debt pile. So that what the Fed and other central banks tried to do is, deal with a problem created by too much debt, starting back in the early 70s with the Nixon gold shock. And then they tried to solve that problem by issuing even more debt, printing money out of thin air and then issuing more debt. Yeah. So that brings us to where we were, say, in 2020, and then the COVID crisis, and then lockdown and furlough. What that then effectively meant was that a corporate crisis in 2008 got kind of shunted up to the sovereign level. The problem we have now at a global level, and it's across all of the Western governments specifically, including Japan, especially Japan, is that a corporate crisis in 2008 is now a sovereign level crisis. In other words, there's no entity big enough to bail out governments when they're on the brink. And that's why the problem is much worse now than it was back in even 2008.
So, as you say, they basically kicked the can down the road, and the can's got bigger as
we're running out of road now is the problem.
Yeah. Okay. So you've got, as you say, a sovereign problem. So governments, it's at the level of governments that aren't. Correct. Well, there's no entity big enough, including central banks. They're not big enough. I'm hearing about banks lending to governments and governments lending to banks. The central bank bailing out the government and the government bailing out the central bank, not just here, but also very much in Europe and elsewhere. Am I right in thinking that?
Yeah, I mean, there's a kind of like a doom loop relationship between these two, because What 2008 showed, to be cynical about it, is that the banks had achieved regulatory capture of Wall Street and the city. In other words, the so-called regulator was actually basically being ordered about by the banks. Something
Yes.
we've seen more recently with the pharmaceutical sector. So the pharmaceutical sector is calling the shots, everyone else just has to jump.
Yeah. Yeah.
So you have got a clear connection. When banks become too big to fail, so-called too big to fail, they are effectively arms of government in all but name.
Yeah. Yeah. So the question that in my mind at the moment is, how come it hasn't collapsed already? Because you would think, it's quite a long time, as you said, 70s, and then, the 2000s, 2008 great financial crash. It did pretty much crash then, but they, as you say, they sort of printed to stop it.
They basically printed, and then they printed shed loads of money, like fire hosing money at the problem to make the problem go away. But as you say, all that really did was buy them some time. So all those chickens are now coming home to roost. And I think that you ask how it's lasted this long. Excuse me. So I wrote a book in 2016 called Investing Through the Looking Glass, which discusses some of these problems, including notably the one of debt. And that was 2016, so that's nearly 10 years ago. Even then, I thought the problem was going to come to a head, and the clock is still ticking. So what this shows is that problems can last way longer and become way more unsustainable than you ever thought possible. But to quote my friend Grant Williams, hasn't is not the same as won't. In other words, just because something hasn't erupted and blown up, crashed, doesn't mean it won't. It just means it's still a question of time.
And it feels like the longer it goes, the bigger it's going to be. So the bigger the crash is going to be. Really.
Yeah, I mean, there's a book that was published some time ago, a good 10 years plus ago, called This Time It's Different, by two economists, Reinhardt and Rogoff, that you may have heard of. And what they said in that book, it was an analysis of basically sovereign debt crises through the ages. And what Reinhardt and Rogoff basically suggested is, once a country's debt to GDP ratio gets above about 80%, beware. It's a red flag that there are going to be problems. To put that figure into context, so they're for them, I think their red flag, red light flashing moment was 80% debt to GDP ratio. The UK is over 100.
Yeah.
Our debt to GDP ratio is over 100%. The US is over 120%. France is over 111. Germany is not so bad. Germany is about 70%. But then, drum roll, Japan is at 260%.
No,
now,
I didn't know that.
Japan is completely technically insolvent. So there's no way on earth that money is ever going to get paid back except in devalued yen. But the US is in the same boat. So if we put some figures for the US together, the US national debt, just the on-balance sheet stuff, so the stuff that isn't relating to things like off-balance sheet liabilities like future pension fund liabilities or future healthcare liabilities, just the on-balance sheet stuff, that's $34 trillion now, $34,000 billion. These figures are completely
mind-boggling.
The mind can't relate to them. They're so huge. I guarantee they will not be paid back. So this is the problem that everyone's now facing, particularly bond investors, which is, do you want to play this game of buying debt anymore? The problem is compounded in the case of the US because of what's happened in Ukraine. So fairly early on after the Ukraine war ignited, the US basically froze Russian assets overseas. And those Russian assets overseas will be things like US dollars and US Treasury bonds, US bonds issued by the US government. In a stroke, they basically fired two torpedoes at their own borrowing internationally, because if you think about what that represents, a friend of mine remarked at the time that even at the height of the Second World War, which was a global hot shooting war, there's an entity called the Bank for International Settlements, the BIS, which is effectively the central bank for central banks. And my friend pointed out that even in the Second World War, the BIS always respected the intellectual validity and the primacy, the legal rights of Germany's foreign assets held overseas. But in a stroke, more recently, the US has basically put a huge question mark over all governments that have US assets, that have US dollar denominated assets, and that hold US Treasury bonds. And when you're one of the world's biggest debtors, you have to be very careful how you handle your creditors.
Yeah, it really.
So there are all these problems coming to a head right now.
So it does feel like a perfect storm, that at any point something could happen that will undermine, like sort of prick that bubble essentially. What sort of things do you think could happen that
Well,
would
one
suddenly
thing
make
that
a
could
crash?
cause, I mean, this is how I think things will play out and are already playing out. So I spent the first part of my career as a bond salesman, so I consider the bond market sort of home turf, if you like. And if you accept this argument, there's too much debt in the system, which I think is now non-negotiable. Nobody could refute that thesis. Then you have to then accept there's only three ways of dealing with the problem. The first way is that government manages to engineer enough economic growth to service the debt. I think that's now impossible pretty much everywhere. So let's park option one. The second option is that government defaults, or let's be more polite and say there's a debt jubilee or a debt restructuring, but it all amounts to the same thing. It's a default. That would instantaneously probably bankrupt the global banking and pension fund industry because they're the prime holders of government debt in the first place. So let's we live in a credit-based system, so let's assume that's not going to happen because it would be Armageddon. So if we eliminate options number one and option number two, what's left? The only plausible response is, funnily enough, what every government that's heavily indebted resorts to throughout all history, which is they just try and inflate the debt away. And so there's this sort of artificial debate going on whereby people say, what's the real inflation rate? But they're missing the point. Inflation isn't some sort of arbitrary rate at which the prices of goods and services is going up. I would take a classical economics perspective and say, what we really mean by inflation is the amount of money creation, money printing that took place back in, say, 2020 over COVID and has gone into overdrive ever since then. But it's been going for 50 plus years. Inflation is creation of money. And what we talk about when we talk about inflation is a second order effect, namely how much has school fees gone up, how much has food prices gone up, how much has oil gone up, et cetera, et cetera. But the cause of the inflation was central bank activity. We'll come back to that maybe later in the conversation. But that's the problem. So you now have a huge debt pile around the world. The US has it, the UK has it, Europe has it, Japan has it, even China has it. How is that pile going to be addressed? I think it's an official, it won't be acknowledged as such, but it's an official, effectively state-sanctioned policy of inflationism. In other words, they're going to inflate the real value of that debt away.
So when you say they're going to inflate, does that mean somehow they are going to put prices up? Or
they'll just keep creating more money. And at some point, the danger with that is because we're already drowning in money. So if you create more money, what happens? Prices go up because you have a limited amount of demand. But the supply of the money is going up. So that's inflation. It's the definition of inflation. So what effectively government or central banks are doing by creating that money is by impoverishing everybody.
So we're paying for it.
That's really what inflation is. Inflation is basically a stealing, a theft of wealth from the people who have it to the people right at the top of the financial pyramid.
What I keep thinking though, as you know, as you explained, you create money by issuing government bonds, and it's the institutional investors, primarily the pension funds, that are buying these bonds. Why do they keep buying? I mean, if I ran a pension fund, I'd be like, whoa, no, don't touch it. Don't give me those government bonds. Thank you very much. I don't trust them.
It's a really good question. So we're asset managers, but we're not pension fund managers specifically. We do manage pension fund money, but we're not a gigantic pension fund business. So the money that we manage, a lot of it is in the form of what are called SIPs, self-invested personal pensions. But we're not obligated to hold government bonds the same way that the big pension providers are. So we can invest in whatever we like that we think makes sense for clients. Pension funds, being very highly regulated, don't have that luxury. They are obligated to have at least part of their schemes in government bonds. And the problem with that, I think it was 2 to 3 years ago, it was the price of one UK government bond. I think it was a 50-year inflation-linked gilt, which is what UK government bonds are called in the UK market. And the price of that bond between January and the Liz Truss budget of, I think it was October that year, fell by 85%. This is a so-called risk-free rate. So if you're a pension fund and you have the liabilities are clearly the amounts you have to pay future pensioners, then the regulator in its infinite wisdom suggests that the best match for those liabilities is to own inflation-linked UK government debt. If the price of that debt is capable of falling by nearly 90% in the space of 10 months or so, it's clearly not a risk-free asset. And that, I think, is a sign of the damage that may be to come, that anybody that holds government bonds of any nature, but specifically the Anglo-Saxon variety, US or UK or European, Western market government bonds, are going to be in for a rude awakening if and when inflation continues to go higher, or if interest rates continue to go higher, which would be our call from where we are now.
But
The thing that, go on.
I was just thinking, might there not be, I'm thinking of what will crash things, might there not be a time when a whole load of institutional investors go, enough, we're not doing this?
So there could be a buyer's strike, or what was called in the 80s the bond market vigilantes. So the concern back in the 80s was that the so-called bond market vigilantes would ride into town and basically stop buying. And if that were to happen, then yields on bonds would go up. That would force interest rates up. And you get into a doom loop because interest rates and bonds are very closely linked to currency. When you're dealing with these trillion-dollar sums that you are in the US Treasury market, the bond market and the currency, i.e. the US dollar, are inextricably linked. And if you have interest rates or the yields on bonds going higher, ultimately what that means is the central bank has to raise rates to try and suppress those yields going much higher. Because otherwise that means the price of your bonds is crashing. And in putting interest rates up, you're crashing the economy. So there are no easy answers to this predicament we're in now.
No, well, this is the thing. So I'm thinking, you know, for us as individuals, we've been working all our lives, put money back, you know, and we're doing it. You're putting money aside. It's quite a worry to think. I mean, really, a lot of a worry, frankly, to think that potentially, suddenly, there could be a bond market crash. So, what do people do to protect themselves from this possibility?
Well, clearly those people who have the flexibility to do it don't hold bonds in the first place. So we don't really hold any meaningful form of debt for our clients. We hold some tiny residual positions, but basically we would much rather own value stocks, cheap but high quality listed businesses of whatever type. We particularly like mining companies because they're very, very cheap right now. And we also like basically other forms of portfolio insurance. But fundamentally, we would be betting on and favoring so-called real assets over nominal ones. So the stuff we're most concerned about now is not, let's say, the stock market. We're not in tech stocks anyway, so that's not really a concern for us. But what we're most concerned about is the risk that you'll get in fairly short order. You'll get some kind of reset whereby the value of bonds falls or the value of currency falls. And as a result, we don't have any meaningful exposure to cash. We don't have any meaningful exposure to government debt. What we do like to say value stocks, we think are reasonable things to own in this environment because they're kind of a hedge against future inflation. There's certainly a claim on the real economy. They're not dependent on politicians' promises. So we like value stocks and we like real assets, notably things like gold, silver. The beauty of things like gold is it's a form of currency that is nobody's liability. So the price of gold is not determined by the credibility of a central bank, like, say, the Federal Reserve or the Bank of England. Gold exists in complete political neutrality. Central banks are buying gold, but that's because they want to shore up the value of their currency. But that's so for us, it comes down to one decision, one binary decision. We love real assets. We hate nominal assets.
Okay.
Things like cash bonds.
So if you've got a pension at the moment, particularly if you've got a SIPP, if you can manage it yourself, you do that. If you're working and you've got a company pension, that's a lot harder because I'm assuming.
Yeah, take a look at what the plan manager allows you to buy by way of funds, and you may want to reconsider the asset class composition of your investments and make them more exposed to real assets in our view, and less exposed to things like government debt and what we could call sort of cynically politicians' promises. I don't know about you, but I trust the average politician now about as far as I could throw them.
Yeah, exactly. Yes, tragically, I'm the same. So you also mentioned about cash losing its value. So if we had a bond market crash, then cash itself would all fiat money, as you say, the money that's used by central banks.
There's potentially the risk that the fiat money loses its purchasing power, but that's a long-term problem anyway. So to give you the long-term perspective on the US Federal Reserve was established in 1913, and one of its obligations was to basically try and protect the purchasing power of the US dollar. The US dollar has lost roughly 99% of its purchasing power since 1913. So the Fed has meaningfully, abysmally failed at one of its core directives. So the Fed basically has two mandates. One is basically protect against inflation, and the second is to try and ensure full employment. We're pretty much there on the employment, but they fiddle the figures constantly. Again, we can't trust any arms of the establishment really anymore, but that, again, that's a secondary issue. But all fiat currencies fail. Every single unbacked fiat currency throughout all history has failed. It's only a question of time.
Yeah, well, this is, again, I think
the bond market crash could accelerate that loss, that loss of faith in fiat money. Fiat money just being money created by the government on a whim. It's supposed to be backed by something tangible.
Because it's as you say, it's faith. These are faith-based currencies, as you say, because it's a fiat currency. The government, the central bank says this is a pound, this is a dollar, and we go, oh, all right.
And just trust us.
Yes, just as
always a bad thing to hear a politician say.
Yes, definitely. And as you say, actually, you mean I do agree with what you just mentioned, that a lot of the figures that we get now from alleged trusted sources, government sources, I don't trust anymore. And certainly the inflation figures and the unemployment figures as well. I really, really question those. Do you think that the inflation figures are genuine now?
No, but I doubt whether they've ever been genuine. They're probably more heavily manipulated now than they used to be. Bear in mind that the UK has quite a lot of inflation-linked debt that's out there in the market. In other words, that's debt whose interest payments and final maturity payment are linked to the inflation rate. So the government has a vested interest to try and suppress the stated inflation rate that actually exists in the real world. So they can, whether you're talking about CPI, which is consumer price inflation, or RPI, which is a retail price index, they have a vested interest in trying to squash that down, because otherwise it's going to, their funding costs go up. And to give you a context of the funding cost problem, here's one from the States. The US government is now spending more on debt interest expense. It's spending on, for the first time in its history, than on military expenditure. And the US spends more on its military than the next 9 biggest countries in the world put together. So that's a sign of just how badly wrong this problem's got. The US, which outspends everybody else, is now spending more on its bond interest than it is on defense. Why
isn't this top line news in mainstream media? Because I mean, this to me is huge.
Scandalous. Well, possibly because the mainstream media or the legacy media are no longer fit for purpose. In the same way that I don't trust government, I don't trust legacy media. So I think a lot of these problems are being discussed, but they're being discussed on slightly more fringe social media platforms like Twitter or X and things like that. They're not being discussed in the mainstream where they should be. I mean, the better commentators will be well aware of this, but this is like the truth that dare not speak its name. That if you work for the establishment, which you basically do if you work for an organ like the FT or the BBC, you're not going to last terribly long as their economics correspondent if you start saying the world's about to collapse.
Because, yeah, I mean, genuinely, that's the way it feels. I mean, the figures that you've quoted from the States and also from Japan, and, we know the UK and Europe are anemic.
We're going in the same direction. We're all going in the same direction.
It's just a question of, different order of magnitude, really, with the figures. I mean, again, I wonder if somebody's listening to this, watching this and thinking, well, what do I do? They might be thinking, time to go and buy land and live off the land. I mean, literally, that's what I'm hearing from various people. Is that what you're thinking?
It could possibly be. I mean, ultimately, everything comes down to price. So we're not huge fans of property because property is a very bond-like asset. It's very sensitive to interest rates. So if your contention is that interest rates are more likely to go up than to go down, which would be our thesis for the next, say, 3 to 5 years, then property is not going to necessarily do particularly well in an environment. And the same for land, but ultimately it depends on how much you pay for it. The worst investment in the world can still work if you buy it dirt cheap. So you can buy the shares of the crappiest company in the world. You'll still do okay, probably, as long as you buy it cheaply enough. If you buy a penny stock and then it goes up, to say 50p or something, you can make an absolute fortune. It's still cheaply priced, but if you bought it at such a dirt cheap valuation, you've made money, even though it's a poor quality business. So the same holds whether it's property, whether it's land, whether it's debt, whether it's equity, whatever. If you buy something cheaply enough, you'll probably do quite well with it. But that's the problem, that these assets typically are not cheap today. I don't think property per se as an asset class is particularly cheap in the UK.
No.
And anecdotally, we know clients that have been trying to sell property, residential property in their case, for some time, and it just keeps going lower and lower and lower. And they're not necessarily willing to take the price. It just means they're guaranteed to get an even worse outcome when they finally eventually capitulate and sell.
Yes, exactly. So your view on property going forward is that it's actually not going to go up. It's probably
Well, it'll depend, because what they say with property is valuation is, what is it, location, location, location. So in the right context at the right price, anything can work. But we're saying as a generic asset class, which property isn't. But if it were, we'd not be huge fans today, because we expect higher interest rates, we expect higher inflation. Property is not a disastrous inflation hedge, but right now in the cycle, we'd rather own hard assets like, for example, the monetary metals, gold and silver.
So if you've got property and you don't want to sell, you're probably going to need to keep it for a good 10 years.
Possibly,
yeah. So ultimately, let's just sort of wrap this up. Just thinking about where are the relatively safe investments as you see it, and primarily it sounds like it's gold and physical assets generally, not so much property, but things you can touch and feel and use.
I think they're safer. I think the concept of a safe investment went out the window back in 2008. So everything's now relatively risky. But that's a problem that central banks have created. That's not a problem that investors have created. People buying tech stocks, the so-called FANGs or now Magnificent Seven, they're creating a bit of a problem because that market's so expensive. But by and large, I think on average, stock markets aren't particularly heavily overpriced right now. But again, it depends. It depends on context. But the market we're most excited by is the market of real assets over nominal ones, over cash and bond type assets, paper money, in other words. And within that market, the things we're most excited by the prospects for are the likes of gold and silver miners, commodities businesses more generally, because we simply know how they behaved back in, say, the 1970s. So if history is going to repeat, the kind of money that could potentially be made by decent mining companies, profitable, cash-rich, low-debt mining companies, could be 5x, 10x, 20x returns. And that will hopefully do us okay in the context of things that otherwise might be collapsing in value, like, say, bonds.
Marvelous. Well, that's a good, I would say, relatively positive note to finish on. So thank you so much, Tim. I will get you on again. We will see what's happening later on. If you never know, your predictions could come true earlier rather than later, but it's good.
One hopes not, but we live in a very uncertain world.
Yes.
So the best advice is, if you're going to panic early.
Exactly. Thank you so much, Tim Price. This has been Tim Price with me, Jasmine Birtles, on the Tin Hat Money podcast. If you like it, then like it, and also share it and tell everybody how marvelous it is, because you want to. Thank you.
Thanks.